Hello and welcome everyone to our next episode of the Knowledge Base series, and this one is called Volume and Open Interest. Why do we need volume and open interest? When we trade and when we look for setups, we usually look for specific levels. We want to see if price reaches specific support levels or specific resistance levels and want to set up our trades accordingly. But we don't just want to trade these levels. We actually want to see what happens around these levels. We want to see if these levels are perceived by the market as being important levels. Because if not, our setups automatically will have a lower success rate and a lower probability. Volume and open interest can actually show us whether at specific levels people jump into the market, people open more longs exactly at the point where we are planning our breakout, or whether people are closing their longs and opening shorts exactly at the level where we are planning to short, for example, at specific resistance levels. And this is why volume and open interest is so important, and I'm going to show you what exactly that is and how we can use it in our trading. So let's start with open interest. The open interest is the total amount of active future contracts in the market. This means whenever price moves or whenever time passes by and people are opening their perp positions, we see that in an increasing number, an increasing amount of open interest. So put very simply, the more open interest increases, the more money enters the market. However, just by watching open interest, we don't know whether this is longs or shorts. This is usually the combined number of open contracts in the market. And consequently, increasing open interest does not automatically mean that the prices will increase. Because as I just said, we don't really know whether more longs or more shorts are open in the market. This is first of all just an indicator of the total amount of future contracts being open in the market at any specific time we're looking at. Now moving to the volume. The volume shows something similar but different in a very, very important way. The volume doesn't give us the total amount of open contracts right now. The volume shows us how much of an asset has been trading within a specific time frame. Just imagine we're looking at the 4-hour candle and we're looking at the volume of this 4-hour candle. So the volume of this specific 4-hour candle just tells us how many units have been traded back and forth within these 4 hours. So if we just look at Bitcoin, and if we imagine that within 4 hours 10 Bitcoins would have been sold and 10 Bitcoins would have been bought, the 4-hour volume candle would show us the number of 20, because this is exactly what happened during these 4 hours. Increasing volume just shows us how much an asset is being traded, and if it's increasing, as I said, it's actually showing us that the asset has been traded more during that period as compared to other time periods. So just to summarize this, open interest, how many futures contracts are currently open in the market, against volume, how much has this asset been traded over a specific amount of time. And what we can do here is we can actually combine this, because the important thing is that just by looking at volume and open interest, we cannot really see the direction of the market. We just see what's happening and whether it's slowly leaning towards higher volume and open interest or lower volume and open interest. And this is why we need to combine this with the current market trend. There's another video in this series about defining and recognizing market trends. If you haven't seen it, I really suggest watching this to understand what we're talking about. So, increasing volume and increasing open interest tells us that the price is moving strongly. Decreasing volume and decreasing open interest tells us that we most probably can get a reversal. And now combine everything and look at a very simple context sheet for you to never be confused again. So we just consider two different situations. The price is going up, so we're in an uptrend, or the price is coming down, so we are in a downtrend. Let's consider the first option. The price is going up. We have an uptrend. At the same time, we see how open interest keeps increasing and how the volume keeps increasing. This is a very strong sign for continuation. More longs are opening the market, more volume is coming in. That means more people are being interested in trading these specific levels, and it gives us more confidence to trade a specific continuation pattern. Now, the other part. Price is still an uptrend, but the open interest is decreasing, meaning people are closing their positions. They're not opening new ones. They're probably not really hoping for price to explode to the upside. They're just closing their positions. And at the same time, we see that volume is going down, meaning people are not really that interested in that level. They don't really plan on doing something specific for this level or with this level. This can be a very, very strong sign of a potential reversal coming in. Now, let's flip the chart and consider the downwards trends. If the price is going down, coming from a higher level, decreasing more and more and more. And at the same time, the open interest starts increasing and the volume starts increasing. This actually shows us that more people are entering on that direction. More people are entering futures contracts, more assets are being traded, or more units of this asset are being traded. This again, as we saw on the upside, shows us and points us towards more continuation. Whereas the other part or the other scenario where price is going down and where open interest decreases and volume decreases, we see again that positions are being closed, that obviously this level is not of a high interest to many traders, and we can easily assume that a reversal is coming in. I will jump into the charts right now and show you some examples just to make the whole thing more tangible again. Now let's look at this Ethereum chart. What we see down here is the open interest. What we see here is the volume. And what we see here, of course, is the price action, the candles moving down. And let's just see what happens right now. We see how the open interest has been increasing sharply. At the same time, we saw that the volume is coming in. This always might be a first sign of a potential reversal. We might see that people start getting interested in this and that something might change very, very soon. Now let's just watch the candles and see what happens. We see how we move across the candles and we see how price starts going up. And at the same time, we see how the open interest starts going up. This means people get interested in this level and they get interested in longing this level. Now we continue. Open interest keeps on increasing, and at the same time we see how we get these volume increases. We got some more volume coming in here, meaning that obviously people wanted this price to break out, to break to the upside. And we continue. Let's see what happens. Again, we see open interest keeps increasing, volume is coming in again and again. Obviously, people are betting on a continuation. This is exactly what we saw in our context sheet. When price goes up and we see how volume increases and how open interest increases, obviously more and more traders are being interested in this level, in trading this trend and the specific levels around the trend, and they enter the market. So until we saw this very, very nice breakout here, we saw open interest keeps increasing, more contracts, more positions are being opened, And we see how volume increased at the same time. So more and more contracts are being traded at the same time. And we see here a nice culmination when price actually breaks out and gives us a strong spike to the upside. This was a very, very good sign of a potential of trading a potential upwards trend and trading a potential breakout. If we would have set our level somewhere here, that always depends on how you set up the trade, this could have been a nice level. And we saw that the increasing volume and increasing open interest gives us more confidence that this level is actually being seen as something important. And boom, we see the breakout, some quick consolidation, and boom, another breakout, 2 successful trades, depending on how you set this up. Now what happens? We see that after the spike, price goes down, which doesn't mean a lot. It could be just an accumulation, but look at the volume. The volume is going down considerably. And at the same time, we see how the open interest starts decreasing. So this points towards a situation where people might not be interested in playing this level anymore, at least not right now. And look what happens. We see how price tries to spike up, but it cannot really get enough force, enough buying power behind it. We have something that we call a buyer's exhaustion, and we put in lower highs, lower lows. Open interest stays more or less the same, but it's not really more people entering the market. At the same time, less and less assets are being traded within the specific time frame. Volume is going down, and we see how after a quick move up, this starts going down again. There we go. And now, as we saw here, again, volume was coming down, price was coming down, volume was moving up again, open interest was moving up again, and we saw how the price reacted. And now the same again. Open interest came down, price comes down, volume comes down. And here's an interesting situation right now, where we see how the price increases while the volume goes down. This is something that wouldn't give us a lot of confidence when trading the market, because this is not something we want to see for a breakout. Consequently, we would just wait until we reach a level, as we see here. Well, again, volume comes in, open interest comes in. Obviously, something is about to happen. Let's see what. And boom, next breakout. Third breakout we've been watching, same style, same pattern every single time. We see how the trend continues, we see how open interest increases, we see how volume increases, and we get this quick spike to the upside. This is something that is a very, very efficient way to trade specific levels, to trade around specific levels, especially when we want to see how price reacts around these levels, and when we plan on, in this case, trading successful breakouts. Now let's look at another example, this time with the price coming down and seeing how open interest and volume react as the price is moving downwards. Look at this. We saw how price was coming up here, volume was kicking in. Somehow we didn't break the local highs, we couldn't break a level, we put in a lower high, which always is a very strong sign for buyer's exhaustion at these levels, and that price is most likely to continue going further down. Let's see what happens here. We see how the open interest increases and the volume increases. Another attempt of a breakout. Let's see if we can break the level right now. No, we can't. Another lower high, which implies a lot of weakness on this move right now, and again gives us more confidence for the price to continue its downwards movement. So we see people lose interest, volume decreases. Here we see some more volume coming in as we sell off. So there's a lot of selling happening, but open interest decreases. So the future contracts are being closed, more and more of those. We go down, we go down. We just have a typical sell-off. This is not a downwards trend that's initiated right now. We just see how, first of all, we couldn't break these levels. We put in a lower high, and we see a typical sell-off. And this happens sometimes at a lot of volume. People are just closing their positions, closing their long positions, meaning the price goes down. And now let's just observe what happens. Open interest keeps decreasing as we saw previously, so no strong sign so far for any sort of trend. But now something interesting starts happening. As the price starts consolidating more and more, we see how open interest all of a sudden starts rising. We see more open interest, more positions, futures positions, future contracts entering the market. More and more money is flowing in, and this keeps increasing. But we cannot break the price to the upside. And look what happens now. Exactly what we had in the other example of the downwards trend in our context sheet. Now price is being sold off. So more and more shorts are opening the market or are entering the market. Open interest hence increases, and we see how volume increases. We see how we get a very high level of average volume right here, supporting the current downtrend. And we continue to go down at very, very high levels of open interest and at very, very high levels of volume. Price is actively being pushed down with longs exiting the market, shorts entering the market, and high volume supporting this direction. There we go. This was just another example of the things and the scenarios we saw in our context sheet. I hope you learned something from this video. I strongly suggest watching the other videos to get more context about the market, to get more context about price action, about candlesticks, about recognizing trends, and about working with moving averages.